Hey everyone, me Kevin here. Could we have just hit a near-term bottom in the face of Goldman Sachs telling us the recession odds have just risen to 35%? In this video, we're going to talk about both. We're going to talk about how maybe we're at a near-term bottom now. We're also going to go through Goldman Sachs data. And this morning's NMI numbers were somewhat optimistic. Third month of up on those Chicago numbers this morning, beating expectations, though still in contraction. A lot of it, though, driven potentially by that pull forward of production and business demand as people try to front-run tariffs. I heard a lot of news that this weekend was some of the best selling you could have done for autos because, hey, the tariffs are coming, so if you need a new car, why not buy it now? Kind of smart. I was also talking to an HVAC tech since obviously, do a lot of real estate work, house hack after all. You know the deal, non-accredited investors welcome at househack.com. They're talking about, hey, now's the best time to sell new air conditioners because we're like, hey, you want to get in before the summer? You want to get in before tariffs and the summer? Buy now, baby. It's like a sales fest out there for the economy. Everything's on sale. Stocks are on sale. Goods are on sale because they're about to get more expensive. The coupon code's about to expire. In a weird way, when you look at it that way, it's all actually somewhat bullish. And so again, we're going to go through the bearish Goldman Sachs piece in just a moment, but I want you to pay attention to some very specific levels here for a moment. Look at SPY, okay, the proxy for the S&P 500. Look at this level right here. We bounced off this level on the 11th, the 13th, the 14th. We just are sitting on that level right now. It is the 550.24 level, and it could be the sign of potentially another bounce to come here. Usually, my belief is that stocks hit their lowest point when you are just before the catalyst event. In this case, we know that Liberation Day, which we're not quite sure if it's Liberation Day yet or Liquidation Day, but whether it's Liberation Day or Liquidation Day, usually the biggest fear in the stock market comes right before the catalyst event. Today is also month end, so you got month end rebalancing going into April. Tomorrow will be April Fool's Day, and then you got April 2nd, the catalyst event. Usually the most pain comes just before the catalyst. Now, at this point, markets are convinced that the tariffs are going to affect somewhere around 25 different countries. There's also the potential for some form of a flat tariff on all countries, somewhere around 15%. We expect there to be exceptions and exemptions for companies and countries, though, quote unquote, from Trump, not as many as previously said. Though we sort of have been getting flip-flopping data on this. So I think at this point, analysts and Wall Street have really gotten to the point of trying to price in the worst, which is, all right, we're going to be getting a lot of tariffs. And part of that negativity is because Donald Trump has really started flipping from this mindset of, oh, tariffs are a negotiating tool and we're just trying to negotiate free trade. This is just, art of the deal kind of stuff. And we've actually started seeing Donald Trump flip into a more of a mindset of, hey, higher tariffs are going to stay. And as a result of higher tariffs staying because they're a revenue driver for Trump rather than just a, tool for negotiating, well, now all of a sudden you're going to get institutions like Goldman Sachs here reducing their earnings forecasts for S&P 500 companies and increasing their bearishness in terms of recession forecasts. So this makes sense. Wall Street analysts are starting to get nervous that Donald Trump is flipping. This is no longer a negotiation tool. This is now a weapon for tax revenue. And of course, the sales pitch to the majority of Americans, by the way, don't really care about the stock market. You watching this are probably part of the minority of people who actually care about financial markets. Most people don't. And those folks are being sold the idea that, hey, if we can tax all of our, allies or trading partners, then we can make it so that 93% of Americans don't have to pay taxes because we're going to remove as a goal the income tax on those making under $150,000 a year. Maybe you don't even have to file an income tax at all or a tax return. Instead, we'll be cutting so much money through Doge and cutting so much waste and fraud that we're going to be getting Doge dividend checks. Obviously, a lot of that remains to be seen, and while we hope we can reduce a lot of waste and fraud, we'll see what can happen. We'll remain optimistic on that. The problem is If Donald Trump truly does go down the road of, hey, this is a permanent revenue driver and we need companies to invest in American manufacturing, you have to remember there are a few problems that we face right now. The number one problem that we face right now is we're in a weaker economic time where we don't have the luxury of company pricing power that we had in 2021, and we don't have the labor market like we had in 2022. The labor market we had in 2022 was much more resilient to this sort of stuff. Like if Trump won in 2020 and did this stuff in 2022, it wouldn't be that big of a deal. We'd be able to absorb it a lot better. Unfortunately, our ability to absorb it now is weakened by a Federal Reserve that is much less likely to cut, a government that has much more debt, a government that is much less likely to stimulate because of fears of inflation, but also a government that all in all is likely to say, hey, this is just the austerity that basically we have to go through to transition our economy to one that drives a significant amount of income from tariffs. But when you combine those sort of lack of downside protections that we have and the weaker economy with an economy that transitions to no tariffs as a source of revenue, we have to say, okay, we now have to punish the rest of the world's manufacturing so much that it actually makes our expensive manufacturing in America look cheap. Because obviously our labor is more expensive, our cost to produce is more expensive, everything is more expensive in the United States. So you have to make everything else relatively more expensive to incentivize manufacturing here. That's what Trump is doing through tariffs. Another option would be lowering wages in America, lowering the minimum wage, or a third option could be, or in combination with these other items, you could also incentivize manufacturing, right? Bring down the cost of manufacturing in the United States through like a Biden CHIPS Act or whatever. Donald Trump is not for a Biden CHIPS Act. It's very politically unpopular to remove the wage floor, like the minimum wage. So you're more likely to just see Donald Trump triple down on this high cost on producing elsewhere, tariffs. The downside problem with that is those tariffs will likely go away at some point in the future, and corporations aren't convinced that those negative externalities are going to stay for a very long time, which makes investing in the United States much more complicated, which isn't good because it doesn't really accomplish what Donald Trump wants in the long term. And this is, I think, why Goldman Sachs is in part suggesting, hey, we might be knocking on the door of more of a recession here. In fact, what they're doing is they say that so far what we've seen, this 9 to 10% S&P 500 sell-off, has been driven by a valuation contraction and ultimately higher risk premium for equities. In other words, for you to have to be convinced to buy stocks right now, you need lower prices. You need lower multiples. But the problem with this is if you price in a recession, you're probably looking at more like, instead of a 10% S&P 500 drawdown, SPY basically 550, you're probably looking more like a 25% drawdown from the highs. Well, 25% drawdown from the highs, which put you at about 459 on the S&P 500, which means we have a long way to go, given that we're at 550 right now on the SPY ticker. So you've got quite a bit of a way to move down here. We're looking at prior multiple bottoms somewhere around 15, 13, and 14. We're sitting at about 17 right now on a consensus forward EPS. So we still have a couple multiples to notch down at least in a recession scenario. And Goldman Sachs says, quote, "We recommend investors watch for an improvement in growth outlook, more asymmetry in market pricing, or depressed positioning before trying to time a market bottom." All right, in English, wait for things to get better with Trump and tariffs, like get through the catalyst. Wait for more ridiculous opportunities in asymmetry in market pricing would be like, as an example, NASDAQ is down 15%, Tesla's down 90%. I'm just making that up as an example. That's an example of asymmetry, right? Because Tesla would be down so much more, like NASDAQ down 18%, Tesla down 90%. That is an asymmetric pricing. It's a massive spread between the two. That's an option. Or you just look at overall depressed positioning, like S&P 500 down 25% or whatever. And Goldman says that we're not there yet because even though sentiment is negative and people are talking a bearish talk, they still have more equity allocation than ever before. This basically means people haven't capitulated yet. They haven't paper handed yet. And so for you to get to the paper, oh man, I hate it when it does this. And we talked about this last time. Where it clicks between the pages, you got to change it to continuous scroll. So much more pleasant. But anyway, so their POV here is, hey, there is downside risk if we have to price in recession. And for every 100 basis point change in US GDP growth, you really need to take about 3 to 4% off of the S&P 500 earnings growth. And that needs to be priced into stocks. So Goldman's raising their recession outlook to 35%. And to me, you kind of have to look at this and say, all right, is this peak bearishness? Or are we, right before Liberation Day hitting peak bearishness? And what you really have to ask yourself is Trump done? Is Trump going to U-turn on these tariffs? My opinion is no. In fact, he's probably more likely to become more aggressive on tariffs rather than less, which does create some more potential downsides, even though I think we have a near-term bounce potential here at 550 on the S&P 500. I think there's a chance you're going to see a lot of profit taking. We were talking about the gambler's fallacy a little bit this morning. There's this gambler's fallacy where you go to the casino with $1,000 and you're up at, let's say, $1,500 or whatever, and then all of a sudden you're down at 500, and you're basically just praying to get back to 1,000. Like, please, just let me win one more hand. Let me get break even and let me get out. And that's usually how people end up going to zero when they're at the casino. But the gambler's fallacy applies to stocks as well, and this idea of like, just give me one more green day and I'll get out. I swear, I promise, I'll diversify. Yeah, we had that. We had that bounce right here, and a lot of people didn't get out. And you can see how rapidly we can return back to the downside. Now, I'm not long-term bearish here. I'm long-term very, very train America, and I know in the future we will return to low interest rates, and we will return to a train America stock market go up. I just don't know what we're going to go through here in the short term. So obviously, I always recommend being risk averse in terms of debt and margin. But watch this for a tactical bounce right here. I think this is an interesting level, especially since the Q is aligned with this as well. I mean, look at QQQ. QQQ right at 460. Tesla's at 248, which is a huge line. And the S&P 500 is at 550. We are at major decision points right now. IWM, the Russell 2000, not so much, not as desirable. Well, actually here, this seems pretty zoomed in here. See, because right now we're trading at 198. I thought 200 was a line. It's actually 199 is a line. Not as clean as the others. You can see here it was a little cleaner than it is over here. But anyway, I think we're at sort of like a major decision point for markets here, where can we get a solid bounce here, or are we just going to continue to bleed? Usually when we get the news, it's not as bad. The problem is we know we're going to get reciprocal tariffs from other countries, and then is Donald Trump going to lash out? Like, does Donald Trump really believe the other countries are just going to bend over and take it? I don't know. So anyway, as we go over here, let's look at a little bit more to Goldman. An improvement in the growth outlook due to an accumulation of healthy data or an inflection positive data messaging, that would be a buy for them. So basically, if Donald Trump flips and he starts becoming a little bit more accommodative, that would be a buy for them, as well as data that suggests we're growing again. Like, you could potentially look at the Atlanta Fed real GDP numbers. Obviously, we've been watching those very, very closely, and seeing some kind of turn up would be nice relative to the turn down that we keep seeing. Unfortunately, we keep getting worse and worse numbers here. These numbers out from 3 days ago, putting our latest estimate of GDP at negative 2.8%, with the gold-adjusted figure at negative 0.5%. We're rotating down more than we're rotating up on GDP estimates, which isn't great. So a reversal in this, along with a reversal of Trump's attitude, then some form of, major asymmetry, major opportunities. With this morning in the Course Member Live, by the way, we were talking about some of my favorite stocks right now. I've got 3 to 4 that I'm really, really jazzed about. And you could join that in the Course Member live streams. You already know this. I don't need to go deep into this. So, you know what it is. We have a Meet Kevin membership now. You don't have to pay a lot to get in up front. Try it. Try it out for 30 days. It's really inexpensive to try for 30 days. Just go to meetkevin.com, try the Meet Kevin membership. You get access to all of the courses, all the trade alerts, every private live stream, every alpha report, every course member meetup. We're going to be doing a course member half marathon later this year. So it means I actually got to get to work and get to training. But you can see all of this and you could join these, lock in your prices for life right here, because we're going to be raising these prices. So you should lock in your prices here, your pricing here. We're going to be raising the pricing probably coming up here in the next week or so. So lock in that pricing now and get in before that pricing goes up. If you lock it in, your recurring subscription will be locked in at that price. Guaranteed you'll have the lowest price. But going back to Goldman over here, so, they actually think the S&P 500 is going to bottom this summer. So a little bit different than this potential for a bottoming now off of that 550 on the SPY right before Catalyst event, liquidation day, Liberation Day. And I don't know, is that joke ever going to get old? Probably. But that's their take. Now, they're also implying a larger recession likelihood, moving us to about a 35% recession likelihood here. Higher recession risk, higher uncertainty, blah-de-blah-de-blah-de-blah-da. I don't know, nobody really knows right now. What we do know is that household allocation is very, very high for the stock market. And the high-end consumer, that upper 10% of consumers, they're the ones driving all the spending right now. So what happens when the wealth effect kicks in and, their stock portfolios start getting whacked a little bit more and they stop spending? Well, the current estimates are that the wealth effect probably won't kick in until S&P 500 hits about 225. Now, that's somewhat around what we saw in the August levels. So look at this right here. Right here is August. 225 is sort of where we hit multiple times over here. We were somewhere between 211 or 511 and 220 or 525, 511, 525 in this range right here. And this, for an extended period of time, could create a negative wealth effect. And that could lead to, lower jobs, lower hiring, lower spending. But we're not there yet. We're still at a pretty solid support point right now. So watch that 550 level on the SPY. Watch for a bounce right here. Watch that bounce at 248 on Tesla. Very, very common place for Tesla to sit right here between 248 and 250. Critical potential breakout point right here. I like to send trade alerts when I see trends and I'm trading them. Obviously, we talk about them in the alpha reports or the course member lives, which you're welcome to be part of on the Meet Kevin membership. But otherwise, look, Amazon, look at how low it's gotten relative to the 242 where it was. You're really starting to see some serious discounts here on stocks. The Amazon's come down. Look at Google. Complete rejection there at 208. You're down in the 153 range. This is a remarkable company, and you're trading for April of 2024 prices. You're almost trading at November of 2021 or of 2021 levels. Look at that. November of 2021. Google was closing at 149. You're at 153 right now. That's remarkable. Some remarkable discounts here. Tesla's trading basically where it's been trading for the last 3 years, so it hasn't gone anywhere. Robinhood's back at its IPO pricing. Restoration Hardware. Look at that line on Restoration Hardware. Holy smokes. Could you ask for a better line? There are some honestly attractive entry points right now. And I'm not here to say we're definitely going to hit a bottom. What it really comes down to is your thought of, is Trump going to go bullish off of this? And can we recover here and rapidly avoid a recession with the damage that's already been done? It's possible. Very, very possible. So we'll keep our fingers crossed that we can avoid a recession here. And don't even get me started on the Rocket Mortgage acquisition of Mr. Cooper. Boy, we had some discussions about that this morning in the course member live stream. But anyway, thank you so much for watching. Go check out the Meet Kevin membership over at meetkevin.com. If you're interested in House Hack or have questions, email us at ir@househack.com, or just go to househack.com to check out that non-accredited round that we have going on. Great way to diversify from the stock market right now. And a lot of people are. We've already raised multiple millions on this round because of, I think, people's desire to diversify right now. Anyway, thank you so much for watching, and we'll see you in the next one. Goodbye, folks, and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.